please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's move to Prakash Diwan then. Prakash, this one is a rather interesting one. EIL, I remember they came out with a good set of numbers and the stock was on fire from there. You believe that it's good for more?
Yeah, so, just before I start explaining EIL and the other picks, just wanted to caution people that this is the first time that instead of focusing on target price, you're also talking about a decent level or zone to get into. And for this stock, you very rightly said, ever since the Q2 earnings came through, it's actually moved up significantly. But I believe the market will offer us a decent opportunity to enter sometime in the first half. Maybe, it's the first quarter itself of 2018. So hold your horses, don't kind of, go and buy on Friday morning or Monday morning. Give time for these stocks to, come into that right zone for your buying to make meaningful sense. And Engineers India Limited, at current levels, is also discounted fairly well. The reason being, Nigel, the earnings in the hydrocarbon business is a lot dependent on execution. And there's a long way. The projects are with a very long cycle in mind. It's not like consumer goods or autos where everything is very visible. But my sense is EIL is in a very great sweet spot. You have seen crude go up suddenly. When OMCs are sitting with the kind of money that they had, they're no more going to enjoy themselves for the way they've done for the last 2 years. They will have to invest into backward integration and put a lot of money behind the refining side. And what's going to happen is scale is going to become critical in this business. So the smaller refineries will have to scale up or die. Okay. So when that happens, companies like EIL start getting a lot of businesses, a lot of order booking, which is that I wouldn't be surprised if they cross 21,000 crores by 2020 also, which is the next 15 months. And that translates into some very decent operating leverage coming in, because you really don't have to deploy too much of assets to be able to execute that. And the margin trajectory will also improve because they have started focusing a lot on PMC, which is very similar to what NBCC does on the construction infra side. EIL does on the hydrocarbon side. So it's just project management consultancy, which pays them much more. The ROEs are better. So all said and done, it's a great stock to have in your portfolio, but buy it on lower levels.
How much lower would you say?
So I would give it a range of 165 to 170, 175. Also, potentially, if something goes wrong with the market, there's a correction which is significant enough. And this time around, out of the picks that we have, quite a few are F&O items. So you also have the potential to hedge your, buying on the cash side. So EIL at that level would make sense. You could keep on accumulating. The target is about 220, 225, 222, 225, which is not much from current levels. It will be about 25% from the level that I'm talking about.
Okay, fair enough. So that's our second pick for 2018.
Going ahead, second half of the year, as well as FY19, will look quite promising. But Prakash, let's get your second pick for today. Well, Kirloskar Ferrous, capacity utilization levels lower, so it's giving them that headroom, and I think balance sheet, not too bad.
Yeah, don't steal away my thunder. No, but with you around, I couldn't help myself but get a metal pick. You've been so good at picking metal stocks. And I think the rally on metals will possibly continue and percolate now from the large caps to some of the select mid caps, small caps also. In fact, this is one of the very few small caps that I felt still hasn't got re-rated crazily upwards and lost out on the potential to buy in. Now, what's good about this company is, one is, of course, the pedigree is very strong. And as you said, financials are in place. They have decent cash on the books, a debt-equity ratio of just about 0.3. They would move into return ratios of 20% plus, 21% in the next year and a half. They are into castings and pig iron. They're two primary businesses. Right. Now, the pig iron business is very simple to kind of understand. But the moment application of steel goes up, the conversion from iron ore to other forms of steel needs pig iron. That's an intermediate stage that you have to go through. Yeah. Now, what was happening is the Karnataka unit, which was there since a long time, never had order books which are very decent. But there's a lot of these mines that have reopened around Bellary and all that. And that's giving them a huge advantage. So they'll get operating leverage. And as you said, castings, they're using 50% capacity. They've already done enough capex. They don't need to put in more money. And castings, what do they make? They supply a lot of equipment to agri equipment manufacturers. So it's tractors, tillers, and that's an area which all of us love. So we know how much there's so much of upside there. So this is in a sweet spot, has a very good relationship with clients for long years, Kirloskar pedigree to back it. And interestingly, last quarter, some of the DIIs increased their stake in this business also. So I think it's probably in that stage where it's getting kind of, ready to take off. I would give it a target of about 145, 150 whereabouts. But you could buy this at current level or at dips, and definitely it will be seeing some major moves for the 2018 kind of period.
Okay, Kirloskar Ferrous, that's one more for you. Prakash, okay, now finally time to pin you down, because incidentally we were just having a discussion on the show today. Prakash likes aviation, but he wouldn't give us a stock name till now. So let's hear it.
Yeah, so that was still market hours.
Yes.
And then, I'm very positive on the fact that this is a extremely difficult and risky business. And we still have the listed players doing very well. And the reason is because we are probably at the takeoff stage for the entire sector, as a theme within the country. And I was quite surprised, pleasantly so, to hear that Indigo has been the first company to have taken off 1,000 flights in a day. Now, 1,000 flights in a day is really big. And very few companies have been able to do this in such a short span of time. But here we are not talking about Indigo. The pick that I have is Jet Airways.
Jet Airways, despite the run-up, that's what I think, despite this massive run on the stock already.
On crude, yeah.
On Jet Airways itself.
No, but see, it's like this, Surbi. Everybody is expecting Indigo to be so well performing that if there's any slippage in their performance metrics, people will punish it. But if Jet does even half as good, they want to reward it amply. Absolutely. So that's the whole expectation from Jet, because it's been a down and out. So people who have flown Jet Airways know that it's primarily because of the connections that they have in certain sectors and the JP miles that you get, that most business class travelers also like this thing, and the corporate side. But my sense is Jet has started doing a lot of things in terms of cutting down costs. The efficiencies would change dramatically. And if you have a KLM or an Air France or somebody bailing them out on the balance sheet, so apart from P&L, the balance sheet will also start getting repaired quite well. And if you notice, quietly there's been a reconstitution of the board itself. So from a lot of people who are just iconic names and generalists sitting on the board, they've actually got people with experience from aviation and similar sectors. And that's driving things very rapidly. So if Jet transforms itself, it'll get rewarded very, very easily. So I'm expecting that to be a turnaround story.
So
of sorts.
How much more in 2018?
I wouldn't be surprised if it goes to that 1,100 kind of a mark as well. So I know it's already moved quite well, but it will be volatile. It's not going to be a smooth ride, but it will reward if people patiently hold on to it, especially this year.
Okay, all right. So Prakash is suggesting that, in fact, Prakash, coming to you next, you're picking up Camlin. The stock has flattered in the past to only deceive ultimately, but this time you believe it's good for more.
Yeah, because it's been a laggard of sorts. Camlin Fine Sciences. Let me run you quickly through what it does, and that's what makes it so compellingly attractive. This company is the third largest player in antioxidants and food flavors. Okay, I mean, which is something that is very unique in terms of chemistry, and it's not easy to replicate. The problem with them was that they have not been able to scale up. But what's now happened is that the Dahej unit in Gujarat, there's a financial closure they've been able to manage. They raised some money through a promoter preferential allotment and some QIP, which was very small though. Now, once it gets into this whole value chain from raw material to final food blending, and especially in the export markets in the US and all, and you all know that US is picking up dramatically, and it's expected to do so in 2018. I was looking at a theme which is linked to the US growth story, and was into chemicals, and had no competition, and this kind of qualified. My sense is it could see a growth of about 30% on revenues, and the EBITDA could probably double in these next 18 months. So that's where the story lies. Even if you discount FY20 earnings, which is 15 months away, probably, with even 21, 22, you get a target price of 199, 200, which is a decent upside from where it is. So hopefully, it'll make the right noises and not disappoint this time.
Okay.
Finally, the 18th stock is a Nifty stock. It did well. It was welcomed into the Nifty. After that, it's not done much. Prakash, I believe it's good for more.
This is UPL. As you said, did well, but it's just come into the Nifty, so there's still a long way to go. What actually worked against them and which brought the stock down was they had a lot of these one-off expenditure which came on account of some legal issues, battles that they were fighting in Europe on patents and all. But their new product development has been so robust that once the Latin American and North American market takes off for them, which there are initial signs of that moving, very soon you will see this company getting re-rated very wholeheartedly. Whatever has been taken away from it, it will probably come back to it in a significant way. So it's a nifty stock. Risk reward is favorable. Discounted 16, 17 times on FY20, you'll still get probably $1,000 as a target, which is 50% from where it is now. So I love the setup. It's a Biocon of 2018.
The Biocon of 2018. Okay, that's going to resonate.
It kind of, surprise people because it's not done anything. Nobody's bought into it, but great pedigree and great product line as well.